Hello everyone. Today we have a new chapter, Chapter 11, Project Analysis and Evaluation. In this chapter, we are going to continue discuss the net present value, internal rates of return, payback periods, and the profitability index. Those investment decision tools we studied in the previous chapter. In the previous chapter, when I asked you to calculate those investment decisions, I always gave you the future cash flows. Right? I tell you the first year $100, second year $300, third year $500. But in real life, no one can be so certain about the future cash flows. Those cash flow numbers are estimated numbers. How do we deal with the uncertainty in life? What if in the real time, the first year's cash flow is not $100, but negative $100 loss? How do you deal with those type of situations? So in this chapter, we are going to give you some tools to deal with uncertainty. The first one is called sensitivity analysis. We are going to test how sensitive is your decision to the change of one single variable. The second one is called scenario analysis, means we are going to check your decisions based on a change of a combination of variables. Monte Carlo simulation is a computer simulation. Then we'll talk about break-even analysis and capital rationings. All the 5 tools discussed in this chapter are the tools help you to deal with the uncertainty in the future cash flows. So we are going to look at them one by one. Alright, so first of all, evaluating net present value estimates. Net present value estimates are just estimates. A positive net present value is a good start. But we need to take a closer look. First, the forecasting risk. How sensitive is our net present value to the change in the cash flow estimates? The more sensitive, the greater the forecasting risk. And the sources of value. Why does this project create value? We have to take a closer look. So how to deal with uncertainty? Sensitivity analysis is analysis of the effects on the project's profitability of changes in one single variable. It could be sales number, it could be cost number, it could be any other numbers. While the scenario analysis measures a particular combination of assumptions. Break-even analysis is the analysis of the level of sales at which the company will break even. Let's look at some numeric examples. Okay. So what happens to the net present value when we change one variable at a time? Right? This is a subset of the scenario analysis, where we look at the different effects of specific variables on net present value. The greater the volatility in net present value in relation to a specific variable, the larger the forecasting risk associated with that variable, and we need to pay more attention to that variable's estimation. Okay. So this is the example we're going to use multiple times in this chapter. This is our baseline model, the base case, expected cash flows. So let's look at our baseline model. Those are the expected cash flows from a new project. 8% opportunity cost means discount rate is 8%, 40% tax rate. Variable costs are 80% of the total sales number, and all the numbers in thousands. Okay, so in year 0, you need to make an investment of $5,400. I'm dropping all the zeros, just for simplicities. And in year 1 to 12 means all the following 12 years are going to be exactly the same numbers. So instead of writing 12 columns of the same numbers, I'm just combining them in one column. So in year 1, 2, 3, 4 until year 12, we're going to look at the same set of numbers. Okay. Initially, we make an investment of $5,400. In the next 12 years, each year we expect the sales number to be $16,000. Variable cost, according to the question, is a constant 80% of sales. So 80% times the sales number, which is $12,800. Fixed cost, our expected number is $2,000. Depreciation is your initial investment divided by the length of the project. In this project, the project lasts for 12 years. So depreciation will be your initial investment divided by 12 years, $450. So the pre-tax profits will be your sales minus variable cost, minus fixed cost, minus depreciation. So the pre-tax profit, $750. You pay 40% tax. So 40% tax times $750, you have to pay $300 tax. So the profit after tax will be $750 minus $300 tax. Your after-tax profit, $450. So your cash flow, what is your estimated cash flow? So here we need to calculate CFO. So the cash flow from operations or operating cash flows. That will be the profit after tax plus back your depreciation. As we mentioned in the previous chapter, the depreciation is a counting number. That is not a real cash flow. So although you deduct $450 depreciation in terms of calculating the after-tax profits, you didn't actually pay $450, right? It's just a counting number. So you have to add back the non-cash item. So $450 after-tax profits plus the depreciation number, $900, is the cash flow we are going to use to calculate the net present value number. Okay, so this table is very simple. In the exam, I want you to replicate this table. Okay, so if I gave you a set of numbers, you will be able to independently calculate the cash flows, which we will use in the net present value calculation. Okay, let's calculate the net present value. Okay, so plug in all the numbers. Initially, at time 0, you paid or you made an investment of $5,400. So that is why there is a negative number in front of it. Then in the next 12 years, each year you will have a $900 cash flows. Okay? Discount all the $900 at 8% according to the period you receive them, you get the net present value, which is a positive number, $1,400. According to our decision rule, yes, you should do the project, right? Because it's a positive number. It brings in almost $1,400. So what is the internal rate of return? Well, if you set the net present value to 0, we back out the discount rate. That is 12.7%. The net present value, $1,400. Internal rate of return, 13%. Payback period will be, each year you have $900. It's exactly 6 years. So 6 times 900 is exactly $5,400. It takes exactly 6 years to pay back your initial investment. Your profitability index number is all the discounted value of the $900 in this big box divided by $5,400 initial investment, and it is 1.26. So the profitability index is always going to be a positive number. Well, unless you incurred a loss in the future, right? If the net present value is a negative number, you will have a negative number for the profitability index. Means you incurred a loss. All right. So let's do the sensitivity analysis. Suppose we have the sales numbers and the fixed cost numbers changeable. Means in the baseline case, we have $16,000 sales. What if the economy is booming? In the optimistic scenario, you could have $18,000 sales. Well, if the economy is not doing really well, in a more pessimistic estimate, the sales number can only be $14,000. How will that change affect your net present value decisions? The second number that can also be changed is fixed cost. In our baseline model, we expect $2,000 fixed cost. But in optimistic estimation, you could have lower cost, $1,500. In the pessimistic estimates, the fixed cost is $2,500. Okay. So first of all, let's do the sensitivity analysis by changing the sales number. So now we want to see how sensitive our net present value to the change of the sales. Okay. So now we will change one variable at a time. Okay. In the pessimistic case, we change the sales number from $16,000 to $14,000. In the optimistic case, we change the sales number from $16,000 to $18,000. Okay, we keep all other numbers the same. So fixed cost is still $2,000 from the baseline model. Okay, now we will have to recreate the table. The variable cost will be 80% of the sales, which is $11,200. Depreciation is still initial investment divided by 12 years, which is $450. Pre-tax profits will be sales minus variable cost minus fixed cost minus depreciation, 350. Tax will be 40% times pre-tax profits, $140. Profit after tax will be profit minus tax, $210. Operating cash flow will be $210. Add back the depreciation, $450, and your operating cash flow, $660. That is the cash flow we use in the net present value calculation. Okay, so now you plug in $660 instead of $900 in the big formula, and you recalculate the net present value, which is a negative number, $426. And the conclusion is, if in the pessimistic case, if the sales can only be $14,000, you should not take the project. Okay, we do the same thing for the optimistic case. We replace the sales number with a higher number, $18,000. We recalculate all the numbers in this Excel file. The cash flow for the next 12 years will be $1140. And then we're going to plug in this number in the big net present value calculation formula. So replace this number in the formula. The net present value is going to be a very positive number. It's more than $3,000. And we should do it. It shows the sensitivity or the sensitivity of the change of the sales. Now we move on to the sensitivity analysis of the fixed cost. Now we check how sensitive our net present value to the change of the fixed cost. Again, we change one variable at a time. Okay, so this time we change the fixed cost. In the pessimistic case, we use a higher cost number. In the optimistic case, we use a lower fixed cost number. Because we are only changing one variable at a time, so we do not change the sales number. So the sales number is still $16,000, the same number as in our baseline model. Again, using the new number, we have to recalculate all the numbers in this Excel file and in this Excel file. If the fixed cost is higher, we will have only $600 in the next 12 years as the cash flow. While in the optimistic case, we will have $1,200 for the next 12 years. When we plug in the numbers in the big formula, again, in the pessimistic case, we should not take the project. In the optimistic, yes, we should do it. Now the question is, shall we do it? Because at the end of the day, you have to make your decision. You either take on the project or not. You cannot say, okay, I'm still thinking about it. You can't do that, right? So what should you do? In the pessimistic case, you should not take the net present value. In the optimistic case, you always take it. So what is your decision at the end of the day? Well, in reality, most of the time people will put a probability into the pessimistic and optimistic case. Like for example, if you think 80% of the chance you will end up with booming economy, the optimistic case. Only 20% of the chance you think the economy will slow down and we are in a pessimistic case. Then you can do a probability weighted average. For example, 80% times this positive net present value plus 20% chance times this negative number. If you add them up, if the probability weighted average number is a positive number, you go for it. If the probability weighted average number is a negative number, you don't do it. Okay. So now we move on to the scenario analysis. So now what happens to the net present value under different cash flow scenarios? Okay. Again, look at this case. Scenario analysis means we are looking at a combination of variable change at one time. So in the pessimistic case, we are going to change both sales and fixed cost number to the pessimistic numbers. Okay? So in the pessimistic case, sales number will be lower. Instead of 16, you have $14,000. Fixed cost is going to be higher. So instead of $2,000 baseline model number, now we have $2,500 fixed cost. In the optimistic case, we will use the best numbers for all variables. In our case, sales numbers will be 18 instead of $16,000. Fixed cost, instead of 2,000, now we have only $1,500. By changing the two variables at the same time, we recalculate the Excel table, and we can see now in the pessimistic case, we only have $360 cash flow for the next 12 years. While in the optimistic case, we have more than almost $1,500 cash flow in the next 12 years. And of course, this is going to be a very positive number, and this is going to be a very negative number. Again, at the end of the day, are you going to do this project or not? You have to give a yes or no answer. How do we do that? Again, probability. It all depends on what are the chances, right? You end up in the optimistic case. What are the chances you fall in the pessimistic cases? Again, if you feel okay, there's a 50-50% chance. So you can calculate the probability weighted average net present value, which is 50% times this number plus 50% times this number. And of course, that probability weighted average is going to be a positive number, and you should go for the project. Okay. So finally, the simulation analysis. For simulation analysis, people will use a computer to do the Monte Carlo simulation. In this course, I will not ask you to do that, but I just want to briefly show you how the computer will do the simulation. Okay, so basically, if you look at the change of the variables, I used $14,000 and $18,000 as an example to illustrate how we will redo the net present value. Similarly, $25,000, $20,000, and $1,500 are just some random numbers I think of. But with the computer simulation, we can do more than that because we know in real life, it's not going to be those three numbers for sales, right? It could be ranging from, say, $10,000 to $30,000. It could be any number between $10,000 to $30,000. If we have to do that manually, it's going to be horrible, right? It's going to be very time consuming. We cannot do it with pencil and paper. So we have to rely on the computer. So the computer can randomly pick a number from $10,000 to $30,000. And then using that number, recalculate all the numbers in that big Excel file and calculate the cash flow and calculate the net present value. And the computer can randomly draw a number from this range for 100 times, 1,000 times, or even 10,000 times. Then you will have, say, 10,000 net present value numbers. Eventually, are you going to do the project or not? You are going to calculate the average of this 10,000 simulation net present value. If that average number is positive, you can safely go for it. If not, you don't do it. So that is the basic idea of the Monte Carlo simulation. So basically, you specify a basic model. Most of the time, we will assume all the variables follow normal distribution. Okay? And you specify a distribution, which is normal distribution for each variable. The computer will randomly draw a number from this distribution, repeat our Excel calculation to compute the net present value. You repeat all the 5 steps 10,000 times, 20,000 times, 100,000 times, and then you calculate the average net present value from this simulation. If that is a positive number, you go for it. If not, you don't do it. Okay, so here are some quizzes. Again, you read the quiz, independently solve the quiz, and pause here, okay? And then you continue the video and check whether you have the same answer. Pause, think, give you independent answer. Then check. Pause. Calculate. Check. Pause. Calculate. Check. Pause. Calculate. Check. Okay. So finally, we have the break-even analysis. There are 3 common break-even measures. First one is called accounting break-even, the sales volume at which net income equals 0. So here the break-even numbers, we are calculating the sales break-even numbers. Okay? So the cash break-even numbers are the sales numbers at which operating cash flow equals 0. Financial break-even number are the sales number at which net present value equals 0. Okay. So the bottom line here is cash flow break-even number is always going to be smaller than accounting break-even number, which is smaller than financial break-even numbers. I'm going to show you in a numeric example later. Okay. Before we do that, we want to talk about cost. There are 2 types of costs that are important in break-even analysis. variable, and fixed cost. So the total variable cost will be the quantity of your production times the cost per unit. Fixed cost are constant, regardless of the output over some time period. So the total cost will be the fixed plus variable cost. Okay, for example, if your firm pays $3,000 per month in fixed costs, you also pay $15 per unit to produce your product. What is your total cost if you produce 1,000 units? And what if you produce 5,000 units? Again, you can pause here and independently solve the answer. And then you can check whether you have the same. Okay? So the total cost will be the fixed cost, $3,000, plus variable cost. Depends on how many units you produce, right? $15 cost per unit, and you produce 1,000 units. So the total cost will be $18,000. If you produce 5,000 units, the fixed cost will be the same, but the variable cost will be higher because now you are producing more units. So the total cost will be $8,000. Okay. So now let me introduce the idea of average cost. That is the total cost divided by the total number of units. So the total cost will decrease as the total number of units increase. Okay? So if you look at average cost, what is the average cost in the first case? That will be $18,000 divided by 1,000 units. So the average cost will be $18 per unit. Well, in the second case, what is the average cost? It's going to be total cost $78,000 divided by the total units, 5,000 units. Okay? So the total cost, the average cost will be 78 divided by $5. The marginal cost, so the cost to produce one more unit. So what is the average cost, the marginal cost under the previous example? Okay, so the average cost will be 18 versus 15.6. The marginal cost will just be $15. Okay, so now we are going to do the break-even analysis using this airplane example. Right. Now suppose you are looking at a airplane project. In year 0, you have to make a $900 investment. Again, here it's actually 900, say, billion dollars. But for the simplicity, I will drop all the zeros. $900 investment in year 0. For the next 6 years, from year 1, 2, 3, 4, 5, we are going to have the following net income numbers. Okay, so for the next 6 years, because we are calculating the break-even number for sales, so we don't really have a concrete number for sales because that is the number we are trying to back out, right? So we don't know what is the break-even number for like how many planes you have to sell. Okay, let's see. Now suppose the total sales number will be if each airplane can be sold for $15.5 billion, the total sales number will be 15.5 times how many airplanes you can sell. Okay, so that is the total sales number. Variable cost number will be the cost, the variable cost for each airplane is $8.5 billion. Then the total variable cost will be 8.5 times how many planes you can sell. Fixed cost is a fixed number, 175. Depreciation, again, is your initial investment divided by how many years of the project, which is $650 each year. Okay, so pre-tax profits will be sales minus variable cost minus fixed cost minus depreciation. Okay, so that will be 15.5 minus 8.5, which is 7 times how many planes you will sell, minus 175 minus 150, which is minus 325. Suppose we have 50% tax. You cut the profits in half. The net profit is the remaining half. Net cash flow for year 0 is your initial investment, $900. And net cash flow for the net present value calculation will be the net profits or the net income add back your depreciation. Okay, so now we are done with creating the Excel file. First, we calculate the accounting break-even point. So the accounting break-even point says the number of planes to be sold to make the net income 0. So what is net income? Net income is this number. So let's make this number 0. Net income equals 0. We have one equation and one unknown variable. We can back it out. So we have to sell at least 47 planes to make the accounting break-even point. So the accounting break-even point is often used as the very early stage screaming number because at least the investors want to see some positive number in the net income, right? If the project cannot even break on the accounting basis, don't even bother. It's not going to be a worthwhile project. So the second break-even analysis is the cash. So the cash break-even point is the number of planes sold, which make the net cash flow from operation 0. Okay, so what is the net cash flow number? So the net cash flow number is this, right? The net cash flow, the CFO. We have again one equation, one unknown variable. You can back it out, 4. It basically says as long as you can sell 4 airplanes, your net operating cash flow will be a positive number. Finally, the finance break-even point is the number of airplanes sold where the net present value equals 0. Okay, so here we can't really use financial calculators because we don't have all the inputs, and we have to rely on the formula. So if you still remember how to calculate the present value of all future cash flows, if you can't remember, go back to chapter 5 and chapter 6, and you will see this formula. This one, the whole thing, is called annuity factor. Okay, so we set the net present value to 0, which is your initial investment, plus using this formula. Okay, the cash flow, capital C, here is CFO, cash flow from operation, this one, times the annuity factor, which is 4.355. The annuity factor only use return, which is 10%, period, 6 years. So we plug in those two numbers, you will get 4.355. You need to sell at least 63 airplanes to make the financial break-even point. It means if you cannot sell more than 63 airplanes, your net present value is going to be a negative number, and you should never even consider the project. Okay, so here is an example of calculating the accounting break-even. What you should do is you should independently solve the problem and then check the solution. We have another example here. A new product requires initial investment of $5 million, depreciates to a salvage value of 0 over 5 years. It means in the next 5 years, Each year, the depreciation is $1 million. The unit price of the product is $25,000. Variable cost per unit, $15,000. Fixed cost, $2 million. Now, first of all, let's consider no taxes. What is the accounting break-even point each year? So here you need to calculate the net income and set the net income to 0. You solve the problem independently and then check. What is the cash break-even quantity? So here we need to calculate the cash flow from operations and then set that to 0. Check. Assume a required rate of return 18%. What is the financial break-even point? Here we need to calculate the net present value and set that to 0. Again, pause the video here, solve it, then check. Okay, so now in the real life, most of the time you will have to pay a corporate tax. Now assuming the corporate tax is 35%, now let's recalculate all the 3 break-even points you just calculated before. Pause the video here and redo all the 3 break-even points, and then check. So finally, we'll talk about the capital rationing. Capital rationing is a technique of selecting the projects that maximize the company's value when the total funds available for investment are less than the total net initial investment needed by all the projects. What does that mean? It means, for example, if you have 2 projects you are considering, each requires $200 initial investment. If you want to do both, you need to pay $400 initially. But your bank account only has $300, which means there's no way you can do 2 projects at the same time. You have to pick one. That is the situation called capital rationing. Means when you don't have the money to do all the projects you want, you have to pick the one that maximizes the firm's value. There are 2 types of capital rationing. One is called hard rationing. So the hard rationing rule means you will never be able to get enough money to do all the projects you want. It's just no way. There's no way you can get enough money. Like in our previous example, you need $400 to do both projects, but your bank accounts only have $300. So we can do both of them. That is the hard rationing. Okay? Soft rationing is the limited resources that are temporary and often self-imposed. What does that mean? Well, imagine in a company, the company has 10 different departments. If the company totally has $100, it may impose a self-imposed budget for each department, say $10. So the CEO may allocate $10 to each department. But if one department finds a super good investment opportunity which requires $15 investment, although the department doesn't have enough money to do it, it can always report to the CFO and asking more money. So the CFO may reallocate $5 from other departments to do the project. So that is one example of the soft rationing. Okay. So the capital rationing involves the calculation of profitability index. When we are choosing the best investment projects to do, we do not use net present value. We use profitability index in capital rationing. In the next example, I'm going to show you why. So if you look at company XYZ, it's considering 4 projects, A, B, C, and D. The total budget for the company is $8 billion. Project A, B, C, D are expected to generate a total value of $6, $4, and $12 billion respectively. So here, the total values, the future values are already present value of cash flows. So to make your life easier, You don't have to do any discounts here. I already report the discounted present value of the future cash flows. Initial investment required for each project is $3.438 billion. Okay, obviously we cannot do 4 projects at the same time because the total budget for the 4 projects will be the sum of 3, 4, 3, and 8. Well, the company only has $8 billion. You have to pick the best projects to do. How do we pick which project to go? Okay, in capital rationing, we have to calculate the profitability index for each project, and then we rank all the projects according to the profitability index. We are going to pick the highest profitability index projects within our budget. Okay, so let's do it. First, we calculate A, B, C, D's profitability index by using the present value of all future cash flows divided by your initial investment. So project A has the highest PI ratio, 2, followed by B and D, 1.5. Then C has the lowest one, 1.33. Okay, now look at our budget, $8 billion. With $8 billion, we can do the first 2 projects, Project A and B. Project A requires $3 billion in investment. Project B, $4 billion investment. And we have $8 billion. After investing A and B, we still have $1 billion left. But we can't do D and C anymore because they require $8 and $3 billion initial investment. According to the profitability index selection method, the company is beneficial if it picks project A and B as a combination. But the question is, why can't we use net present value in capital rationing? Let's look at the next page. Now, let's calculate the net present value for each project and rank all the projects according to the net present value. Definition is your future cash flow discounted to time 0. Okay, so the present value of all future cash flows minus your initial investment. And then we rank all the projects according to the net present value. Project D has the highest net present value, $4 billion, followed by A, B, and C, $3 to $1 billion. Since our total budget is $8 billion, according to the rank of the net present value, we can only do Project D because Project D will require exactly $8 billion. If we use all the $8 billion budget on Project D, we are going to have a net present value of $4 billion. But comparing to the combination of A and B, $3 and $2 billion, if we follow the profitability index selection tool, doing project A and B together will generate $5 billion net present value to the company. So we are better off using the combination of A and B. So that is why, in terms of capital rationing, we always use the profitability index method instead of the net present value method. Okay, so that's the end of this chapter. If you have any questions, please email me